This is a lecture from Open Tuition. To benefit from the lecture, you should download the free lecture notes from opentuition.com.
Right, let's go through and pull it all together and have a look at a big group statement of cash flows question. So the example that we've got there is all about a company, is it called Dove? Let's go through and have a look at the requirement first, which is there right at the very bottom of the following page, isn't it? So what you've got there, no surprise, it wants the consolidated statement of cash flows, and it's there for the year ended December 2015. Okay, so what you can see there is that you've got the usual information. You've got the position statement of Dove. So you've got there your brought forwards for 2014 and your carry forwards for 2015. As we scroll down, we can also see as well there, can't we, that you have the statement of is it profit or loss. So in a moment we shall be going through there, shan't we, and starting at profit before tax. Just be aware, this is what the examiner does tend to do now, throws in a statement of changes in equity, which can be very, very useful. So I draw your attention here to the fact that you have, is it some non-controlling interest, and look at what happens there. And also as well, if you look at the equity shares, you can see there's been an issue of share capital. You can see that there's been some dividends. So some dividends out of the retained earnings. Is that the dividends maybe that have been paid to the parent? There's a dividend that's been paid out of the non-controlling interest. So is that the dividend paid to the NCI? So it actually gives you a lot of information without requiring you to go through and do some of the calculations. If you look at the additional information, it tells us that there's been an acquisition of the subsidiary, Fred, for 50 million. We're given the fair value of the net assets, so we'll need to adjust for those, won't we? It also says that we have an associate, so we'll need to maybe work out the dividend received from the associate. And then it gives us a little bit of information to do with property, plant and equipment, doesn't it? It talks about depreciation and it talks about the sale of an item of property, plant and equipment as well. Okay, so we know we are preparing a statement of cash flow. So what I would do is I would get myself a blank page of A4 paper and I would head it up with my group statement of cash flow. I would then leave that entire page blank. Okay, although before I do that, I would put in there your operating activities as a heading. If you want, you can also put in profits before tax. Okay, so at the very top of that first page, group statements of cash flows, operating activities, PBT. Leave that page entirely blank. Turn the page over. You then have, is it your investing activities? So at the top, you can put your investing activities. Halfway down that page, you can then think about your financing activities. And then on the bottom 3 lines, I would just go through there and look at the movement in cash and cash equivalents, the brought forward and the carry forward. Okay, hopefully everything would work out in the end, wouldn't it? And then what you can do, that's all on, one page of paper, one on one side and then on the other. You could then go through there and grab yourself a separate page of paper and head it up there with the workings. Okay, excellent. But go back to the bottom of that second page, look at the movement in cash, the brought forward, the carry forward, because what we can go through and do there is that we can look at the cash and cash equivalents. Opening is 230, closing is 190. It's P2, so there's unlikely to be any, if you like, overdraft. Okay, that was F7. Here, put in your opening cash as 230. Closing is 190. If that's the case, then the movement must have been 40. Okay, there we go. You're unlikely to score any credit for that within the exam. I think that's a bit unfair. It'd be nice to get 1 mark for it, but past experience dictates that there's no credit available for it, so you don't even need to do it, but it's up to you. Right, everybody happy with that there? It eases the nerve, doesn't it? It puts you at ease. You ease yourself into it. Right, what we then go through and do, following on from our methodology, is that we look at the group profit before tax first. So we start off at PBT. PBT is it at 375. So I can put in my 375. Easy. Put it in, get yourself a mark. Brilliant. Once you put in that, remember what we said then is that we look up and then we look down. Okay. So when we look up, let's adjust first of all for the share of profit of associate and the finance costs. So we've got there, is it the finance costs? We have there, is it then the associate? So I think the finance costs were 55. So get them the right way round. So we add that back. The share of profit of associate was 40. That was added in, wasn't it? So we need to deduct that in getting back to your profit from operations. Okay. Good thing there is it's really easy on a group statement of cash flows to go through there and pick up the marks. You get 1 mark for every number that you put in. Okay, so 1, 1, 1. Okay, that's how easy it can be. The finance cost then converts itself into an interest paid, doesn't it? So part way down that first page, you've got there, is it your interest paid? And your interest paid, is it equal just to the 55? Or were there in the statement of profit or loss, or sorry, the statement of financial position, any opening and closing interest payable balances? No. Okay. So that expense that you see of 55 in profit or loss is also what is then paid. There's no opening and closing figure to adjust for. Okay. Excellent. Once you've done that, we've dealt with the finance cost and the interest. We've dealt with the associate, adjusting for the non-cash item, but we haven't adjusted for the dividend received. So the dividend received from the associate, we could work it out with regards to a T account, but in this question, it's made a little bit simpler because what we've got there is it says that we own 20% of an associate and they paid a dividend, is it there, of 150 million. So we will have received our share, 20% of that 150 million. So that is there as 30 million. If you want, you could work it out as a T account. I'm not going to go through and do that because it's not necessary. If you want, work it through in your own time. Put in the T account, put in the opening, the closing, share of profit of associate, and then work out the carry forward, or sorry, work out the balancing figure, which is there as the dividend received from the associate. But so far, so good. Our technique in terms of our exam approach is holding up pretty well. Start at PBT, look up. Once you've dealt with the non-cash and the cash aspect, then begin to look down. And when you look down, that is when you see tax. When you see tax, that then means that we need to look at tax paid. So within your operating activities, so towards the bottom of that first page, you've put in your interest paid, you've then got there, is it your tax paid? Okay, that requires a working, it requires a T account working. So what I would do there, draw it up and call it tax. Okay, so again, we're going to have our opening tax liabilities on the credit side, our closing there on the debits. Okay. So if I go through there and look at my opening tax figures, My opening tax figure on my deferred tax is 190, and on my current tax is 110. So 190 and 110. The closing is there as 150 and 220. So 220 and 150. Just be careful. We then need to take the statement of profit or loss tax figure, which is there, is it as 95. Before you then balance it off, just have a quick check. I don't think it makes any difference here, but just see if there was a tax payable balance acquired on acquisition. And there isn't. There's PPE, inventory, receivables, cash, and payable. So just a trade payable. So there is no reason there to go through and adjust for any balance acquired on acquisition of that subsidiary. So 395 right, 395 left. The balancing figure that you have is there as 25. There we go. Okay, so you've credited the bank and debited your tax payable with 25. Again, that then needs to go through, doesn't it, and appear as our cash outflow, which is there as 25, and that will then help us to work out our net cash from our operating activities afterwards. But that's way off in the distance, isn't it? Let's not worry about that there. If you're worrying and thinking about marks, you're always looking at least 2 marks minimum for your tax paid. Remember, technique, so still looking at profit or loss, is that we've looked up, we've looked down. When we keep looking down, you get to the 280. Now, you think, well, that's it, I don't need to look any further. You do, because that 280 feeds in down here, doesn't it? Okay, into your group statement of changes in equity. And why I think that's then really useful, because that then helps you work out the dividend paid to the parent. You don't need to work it out. It's given to you. And also the dividend paid to the non-controlling interest. Again, you don't need to work anything out. It's given to you. So from your profit for the year, that makes you think about your dividends paid. So you've got there within your financing activities, you've got there, is it your dividend paid to the parent, the dividend paid to the non-controlling interest. I can't remember what they were. I think they were 65 and 20. Double check. Yeah, 65 and 20. Perfect. So dividend paid to the parent, 65. Dividend paid to the NCI, 20. Okay. Again, they are dividends paid. They are outflows. Again, if you're curious, we're just putting the number in. There's no calculation, so it's 1 mark for each. If there was to be a calculation involved, you might have to get then 2 marks. It depends on what you prefer. Okay, do you want to do calculations and get more marks, or just be given a number and just get 1 mark? I prefer to be given the number and just put it in for 1 mark. Okay, excellent. So far, so good. Everybody happy with where we are so far? If you're not, stop the video, go back and just rework it. Because what we're going to go through and do now is we move on to the statement of financial position. The first area that I go through and look at there are my working capital balances. So you've got there, is it the inventory, the receivables, and is it there right at the bottom, the payables. So what you've got there is you're going to draw up a separate working, aren't we? Whereby we have your inventory, receivable, and payable columns. We put in the brought forward. We look at adding on the balances at acquisition to give me what is expected. We then compare that to the carry forward. So the actual, before we then look at the movement, don't we? Okay, remember that pro forma that we looked at in one of the earlier videos. It's vitally, vitally important. So inventory, opening 580, closing 530. So opening 580, closing actual 530. Receivables, opening 390, closing actual 456. Payables, opening 430, closing 300. And in F7, you'd have just looked at the normal movement there, wouldn't we? However, P2, we need to deal with the acquisition of a subsidiary. So what we have there, in the notes, we know there's a sub that's being acquired. You've got three balances to adjust for: inventory, receivables, payables at 20, 15, and 9. So 20, 15, and 9. And then we can work out the balances that we would have expected before we then compare it to the actual. Okay. So again, you've got 600, 405, 439. And you can see there that in terms of the inventory, the movement that you have there is a reduction of 70, isn't it? On the receivables, there is an increase, is it, of 51. And on the payables, there is a reduction of 139, isn't there? Okay. So if there is a reduction in inventory, you have more cash, don't we? So we have there your increase. Sorry, careful. Let's just double check. I've lost my working. Where did it go? Did I just delete a page? I think I did. I've lost my working. That's very strange, isn't it? There it is. Found it. Okay. A reduction in inventory. That was it, 70. Okay. So I have a reduction in inventory of 70. Good job I did double check, wasn't it? There we go. A reduction in inventory of 70 means that you have more cash, isn't there? Okay. Then what you also have as well was it an increase in your receivables. If you have an increase in your receivables, you have less cash. So that increase in receivables is there, is it, as 56. So that's less cash. And then was it there on your payables? A reduction of 139. So if there is a reduction in your payables, again, you have less cash, don't we? You've paid off your suppliers. There we go. Maybe that reduction was there. Was it as 139? Double check. Yeah, 139. Excellent. There we have it. Okay, so that working there is fundamentally important, isn't it? Okay, because it goes through there and takes account of the acquisition of the subsidiary. Don't try and take any shortcuts. If you do, all the very best of luck to you. Okay, excellent. So we're looking at the statement of financial position. We've dealt with all the current assets. We've dealt with the current liabilities now, haven't we, in terms of tax payable, trade payables. We've got some long-term borrowings, aren't there? You can see there's an increase in borrowing, so that's a cash inflow. So if you go to your financing activities, you've got there, is it your borrowings? And the movement there was 100, wasn't it? So now 300. It was 200 if memory serves me right. So that's an inflow of 100, isn't it? So once you've dealt with the current assets, I then start to look at the debt and the equity sections. So I've looked at the borrowings. I then need to look at the share capital. You can see share capital has increased by, is it 200, which ties in quite neatly, doesn't it, to the issue of shares there within the statement of changes in equity, is it there of 200. Just be careful here, that share issue is entirely for cash. There's nothing to do with, if you like, a share issue as part of the acquisition of the subsidiary. If there were, there might be some complex adjustments that may be required, but we'll leave that for exam standard questions here. We're focusing on the style and the fundamentals of group cash flows. So you've got there, is it an issue of shares? And that issue of shares gives you a cash inflow, is it of 200? Okay. All going swimmingly well so far. And the reason why I tick everything off is because then you can see what you have and haven't done. If you look at retained earnings and non-controlling interest, we've already actually dealt with those with regards to looking at the dividend paid to the parent and the dividend paid to the non-controlling interest. I've actually already dealt with my investment in associate because I've dealt with the dividend received from the associate. Okay, we might draw up the T account at the end just to show you that it all works. And then what we've got is property, plant and equipment and goodwill. Okay, so goodwill, it looks like maybe there's been an impairment. Property, plant and equipment, there's all sorts to deal with, isn't there, with regards to PPE? Because when you're looking at PPE and your investing activities, you've got the, is it the purchase of PPE? You have, is it the disposal of PPE? But that was difficult at F3, it was difficult at F7. It's just as difficult at P2. It's one of those weird things within the financial reporting, financial accounting, corporate reporting silo within the ACCA syllabus, is that PPE is just difficult, okay, even though you do so much of it. So we'll leave that because there's actually easier marks to get. I'll come back and do it shortly in a moment. But what you fail to realise there is that on acquisition of the subsidiary, there's a very, very, very easy mark. Because what we've done there is we've paid 50 million to acquire the sub. But don't forget there that you want to net off that balance, don't we, with the cash that came in on acquisition of the sub. So 50 less 3, I think, gives you 47. Oh, careful. So you've got there, is it, I shall move it down a bit. You have there the purchase of the subsidiary. 50 less 3 gives you an outflow of 47. Again, that's a pretty straightforward mark to go through and get. Okay, excellent. Once I've done that, I'd leave the goodwill. You can do that next if you want. Let's play around with the PPE and get the easier marks from property, plant and equipment. There's some easy marks within the additional information. So what you've got there is that there's a non-cash item there, is it of depreciation of 130. So if you go into your operating activities, so that big first page that you have, you've got then, is it your depreciation is an expense of 130, which is non-cash. So you add that back. Whilst we're there, I think there's also the sale of PPE with a carrying value of 43. It was sold for 50. So you have, is it your profit on disposal? So it was sold for 50. It had a carrying value of 43. So that's a profit of 7. That's increased profits, but it is non-cash, isn't it? It's just an adjusting journal entry that we process as part of PPE. It's an accounting entry. So it pushed up our profit, not our cash, so we need to remove it at 7. Don't forget, however, then to deal with the proceeds. So we disposed of PPE, was it there for 50 million? So that was nice and straightforward. That's pretty easy. So again, if you're looking for easy marks within the exam, I think you can find plenty of them there. You will get to them as you work through our formulaic approach. Okay. The hard bit is there looking at the purchase of property, plant and equipment. It's for that I would draw up a T account. So the property, plant and equipment. Nice big T account. So we've got there my opening PPE and my closing PPE. Back to the SFP. Opening 1250, closing 1745. There we go. What else has happened? Well, I think there was depreciation. The depreciation that we had within the question, was it 130? Yep, there we go. Depreciation charged of 130. So the depreciation reduces the carrying value of 130. I think there was a disposal. Was the disposal carrying value? So remember, it's all at the carrying value is there at 43. Double check. Yep, again, 43. Please, whatever you do, don't put in the proceeds. That's a common mistake that people make. There's been no revaluation. So what we have there is we will have our balancing figure. The balancing figure is the cash figure, which essentially is for your additions, isn't it? So if I total it up both sides, 1745 plus 130 plus 43 gives me the 1918 on the right. So that needs to be 1918 on the left. My balancing figure for my cash is there as 668. That there is the purchase of my property, plant and equipment. So purchase of PPE is there as 668. Nice big cash outflow there. Okay, excellent. I think the only little bit that I am missing, you need to tick off everything within the statement of financial position, is looking there, isn't it, at the goodwill. Be careful. Something has just come to me. Yeah, you're probably shouting at me. Apologies. We missed out the PPE, didn't we? Yeah, the acquisition of the subsidiary. Careful there, Christopher, because my brain is a little bit frazzled from everything that we've worked through. So you've got the sub. The sub had a fair value PPE, was it there, of 13. So I put that in. I thought things looked ever so slightly wrong, but that's what happens. So your purchase of property, plant and equipment is 655. Okay. Phew. There we go. 655. So I can go back there, correct my figures. Is it there? 655. Okay. Easy mistake to make within the exam, but that's just a good learning demonstration, isn't it? To make sure that you do not forget it. Okay. Brilliant. Last thing to go through and do is to go through there and look at the goodwill. And the reason why is because when we're looking at the goodwill, we need to work out the goodwill on acquisition of this subsidiary. So they paid 50 million. The net asset to that is it as 42. If we're not told anything else, then the value of the non-controlling interest would normally be given to you within the question. But again, my mind is fried. It's all of the share capital. So there's no non-controlling interest. So what you've got there is that you've paid 50. The non-controlling interest is nil. And we deduct the net assets at acquisition, which were 42. That gives me their goodwill on acquisition at 8. Okay. Why is that important? Well, the reason why that's important is because if you go through and look at your goodwill, you've got your opening goodwill as an asset and your closing. So the opening goodwill was there at 1230, 1184 is the closing. So 1230, 1184. You've got the acquisition of the sub, and I think the goodwill that we calculated there was 8. So when you balance it up, 1238 on the left, 1238 on the right. Does that give you a balancing figure of 54? That 54 is reducing the goodwill, and one thing that reduces the goodwill is an impairment, isn't it? Okay, so you've got an impairment of the goodwill. Impairments are non-cash items. So what I can go through and do there is right back to my operating activities. I can put my impairment in and reference it to a working, and I can add it back there. Is it at 54? Okay. Have I dealt with everything? Well, yes, I have. Okay. Because I've gone through there, haven't I, and ticked off all the figures on the statement of financial position. Okay. If you're brave enough and crazy enough within the exam, then by all means feel free to total up everything within the statement of cash flows and see if it goes through there and comes down to that movement as an outflow. Is it there of 40? If it does, amazing. If not, don't cry about it. It's not worth it. Okay. Just to go through and just to confirm that we have done everything. Let's just check on this associate that it does balance up. So brought forward, carry forward associate. You didn't need to do this because we had the dividend received from the associate we were able to calculate. So opening 190, closing 200. Closing 200. We then go through there and put in the share of profit of the associate. And the share of profit of the associate was there, was it as 40? The actual dividend that we received, we went through and recorded it, didn't we? Was it the 20% of, it was that long ago, I can't remember, was it 20% of 150? Yeah, 20% of 150, which is there, is that as 30. So it's 230 right and 230 left. So if you draw up the T account, you'll find that it balances. There are no other cash flows. There could be some other funky cash flows that may arise to do with the associate. Maybe you've purchased an associate during the year. Maybe you've disposed of an associate during the year. But the key one that you're likely to have to calculate within the exam is that dividend received. We could have calculated it using the T account, but here we were told a dividend. We were told our percentage ownership of the associate. So there was a much quicker way of working it out, wasn't there? Okay. There we go. Excellent. That's it. That's the end of your statement of cash flows. I think that's now also the end of the world of groups, isn't it? So what I'd do is I'd take a bit of a break from your studies. I'd literally leave things alone for a good few hours, maybe a day or so. Give yourself the chance for the old grey matter to piece itself back together. You'll have done quite a lot by now. Then once you've done that, maybe revise groups a little bit, practice some questions, and then come back into the world of the accounting standards. The good thing is that when we look at the accounting standards, is that we start with the easier ones first. So we begin to look at property, plant and equipment, intangibles, impairments, so things that you've seen previously from F7. So we do ease you back into it. But for now, that's everything to do with groups. So very best of luck with anything that you have with regards to the exam. If you've got any questions, then don't hesitate to ask us on the Ask the Tutor forum. Other than that, I'll see you within the next chapters when we all start to look at the accounting standards.